Hello and welcome back. This is Christopher Aaron. This is the iGold Advisor channel, and we are going to be looking at the most important signal in all of finance. No joke, no exaggeration. This is it. This is it right here. It is May 14th, 2025. What am I talking about? It is the Dow to gold ratio. Whether you're investing only in physical gold, only in physical silver, or whether you're investing in some of the gold and silver mining companies, any or all of the above, this is the most important signal for you to be following, not only for precious metals investors, but for general equity investors. The largest stock markets around the world are all tracked to the Dow to gold ratio. Basically, every human on planet Earth is going to be impacted by this ratio. So I want to show you what we are seeing here, why this is so important, and the signal that we have just observed. It is May 14th, 2025. I'm glad you are here. Make sure to hit the subscribe button and the bell icon to be notified when these videos come out. If you have 1 second to give it a thumbs up, I very much appreciate that. It really does help out the algorithm here. Last but not least, if you're not following our free feed on X or Twitter at iGlobalGold, you're missing out on free posts. So don't miss out. Make sure to join us for free on iGlobalGold. Let's get into this absolutely critical signal here as we get into the middle part of May. There's our legal disclaimer. What am I talking about? Here it is. The Dow to gold ratio from 1970 through the present. This is a big one. I'm not cherry picking these dates. The reason I'm choosing 1970 is because in 1971, August of 71 is when gold began to be freely traded. So we're looking at all of the freely trading data. There's no other data to refer to as far as freely traded gold prices. And what is this Dow to gold ratio here? Let's define this in case you're not familiar with this. The Dow to gold ratio simply is the number of ounces of gold. Think about your gold coins. The number of ounces of gold required to purchase one share in each company of the Dow Jones Industrial Average. How many companies are in the Dow Jones? 30. So it's the number of ounces of gold required to purchase one share in each of the 30 companies in the Dow Jones. Now, remember, every stock market is correlated around the world. So if you're saying, well, the Dow is only 30 companies, why don't you use the S&P 500? Why don't you use the New York Stock Exchange? Why don't you use the FTSE 100? Why don't you use the Australian Stock Market Exchange, et cetera, et cetera, et cetera? The reason is, when push comes to shove, they're mostly the same, with an extremely high level of correlation. So we can use the Dow Jones Industrial Average since it's the longest dated. It goes back all the way to the mid-1800s. And in fact, we have analogs going back to the 1700s. We have like over 250 years of data for the Dow Jones Industrial Average. So it's better to use the longest dated one. So number of ounces of gold required to purchase one share in every company in the Dow. Okay, fine. How does this work on the chart? Basically, if you're not a chart person and you just want to understand what we're looking at here, the higher that this thing goes, the better that the Dow is doing. The lower that this chart goes, the better that gold is doing. So if you're a gold investor or a silver investor or a gold or silver mining investor, you want to see this chart moving lower. You want to see it moving down here to the bottom where gold is higher. You do not want to see it up here where the Dow is higher, because that would mean that precious metals are out of favor. The economy is doing fine. General industrial technology stocks are outperforming. As a precious metals investor, you want to see this chart moving lower. Okay, that's the backdrop. What do we have here in this spectrum? Let's look at the data from 1970 through the present. I want to start drawing your attention to the major lows. The major lows that this ratio has seen over the course of the last 55 years. Pay attention here to this low in the year 1980 when the ratio hit nearly a 1-to-1 level. We'll come back to this in a moment. Look at this major low here in 2011 when the ratio hit a bottom just above 6.5 on the index. Look at this low here back from the coronavirus panic in 2020 when the ratio hit about 12. And so notice if we just draw a trend, 1, 2, 3, we draw a trend of these three major lows, and then we ask ourselves, does this look like, let's say, the trend that this market, in fact, was respecting here for the last 45 years? We extend the trend forward and look at how right there, a fourth low all matched along this same trend. And so, yes, while we do have some slight undershoots here in 2011 and 2012, and just a slight overshoot there in 2020, you look at the nature of this trend here going back from the year 1980, 4 very nice hits all lining up. And in sum, we can call this a 45-year best fit trend. Can you see what I'm talking about? Over 45 years, this ratio was rising, what? In favor of the Dow, in favor of mainstream stock markets, in favor of technology stocks. 45 years. This is significant, guys. Who do you know who's talking about this? Okay, 45 years in favor of the Dow, rising along a best fit trend until what? Boom. Until just 3 months ago. Look at this right here. Look where my mouse is. And notice that these two data points right here, and by the way, every bar or every line that you see here on this chart represents 1/4 worth of data. So this was in the first quarter, at the end of the first quarter, and now we're into the second quarter of data where we have what? A trend break. A break of a 45-year trend. The former trend was what? Higher in favor of the Dow. That has been broken, arguing that what? A new trend is in the process of developing, lower. Remember that lower is in favor of gold. The lower that this moves, the better that gold is doing. So, yes, over the short run, we have gold that is in a little short-term downtrend. If you don't know what I'm talking about, make sure to go back and watch the last video. We gave an update on gold itself. Gold is in a short-term downtrend. Here, we are looking at the relationship between the Dow Jones Industrial Average and gold itself. And this is a 45-year trend. How often do you see a 45-year trend in favor of one market that gets broken? I would argue perhaps only a handful of times in one's lifetime will one observe let's call this a multi-generational trend rising in favor of the Dow that has now broken lower in favor of gold. Understand the ramifications of what you are seeing here. So, this is significant. Now, what I want to do is take that exact same chart. There it is. I just made it a little bit smaller. Exact same chart, and I want to share with you what is within the realm of reason for my expectations right now for the Dow compared to gold, given that we have just seen this 45-year trend, in fact, break lower in favor of gold. Within the realm of my expectations is that over the course of the next 10 to 15 years, this is not going to be a quick, 1 month or 1 week cycle here. Over the course of the next decade or two, now that the 45-year rising trend has broken in favor of the Dow, I expect there to be a 1 to 2 decade move lower in this ratio in favor of gold. Now, do you think that I'm crazy? Do you think that this ratio could get all the way back down here to the bottom? Let's say 1-to-1. Like this can never happen. This is impossible. Some people might claim that. Aha. Those people are not studying history. History doesn't always repeat, but it often rhymes. Go back to the year 1980. Gold was in a bull market. It had been in a bull market for almost 10 years. Since freely traded gold, gold was rising. And in the year 1980, gold hit $850 per ounce in January of 1980. What was the Dow Jones worth in that exact same moment in time? 850 points. In other words, this ratio bottomed at a major peak in gold and a major low for the stock market at a 1-to-1 ratio. Where are we right now? Can you see the level right now? Right up here where my mouse is. Look right up here. Just below 13-to-1. 1-to-1, 13-to-1. So, according to my analysis, over the course of the next 1 to 2 decades, if this trend break holds, and we're already going on 3 months of data where it's below the trend, so far so good. If this trend break continues to hold, this ratio should be declining to roughly a similar value as it hit in the year 1980 at 1-to-1, except it is not going to happen with gold falling all the way to 850 and the Dow falling all the way to 850. There's been way too much money printing. There's been way too much debasement of the currency. What would this ratio be now if it hit that exact same level that it hit in 1980? Well, what is the Dow right now? It's about 42,000. So, if this ratio is going to achieve the same level that it hit in 1980, this is not some sort of hypothetical, imaginary, if only we're lucky kind of situation. This is established data from freely traded history. In the last generation, 1-to-1, that would equate by the 2030s, Dow 42,000, gold $42,000 per ounce. Think about that. Think about that for a moment. Where we are right now, yes, gold is in a short-term downtrend. We talked about that. It could decline back toward 3,000. It could decline to 2,800. We talked about that last week. Think about the big picture. Do not lose the forest for the trees. We have a 45-year trend break that has just happened. The former trend was rising in favor of the Dow. That argues that the new trend is going to be lasting several decades lower in favor of gold. Do not lose the forest for the trees. Will it be exactly 42,000 and 42,000? No one can tell for sure, but we have established precedents of this level being reached at major tops in gold and major bottoms in the Dow. So this is within the realm of reason of what I expect from a big picture scenario looking forward 1 to 2 decades at this time. I wanted to explain to you the significance of that Dow to gold ratio when you keep in mind where gold is right now and what could be coming over the decades ahead so you don't lose your perspective. If you like the type of analysis you see here, you should know that we produce videos like this that are much more in-depth, where we cover not only the 45-year history, for our premium members, we have covered the 150-year history of the Dow to gold ratio. And I want to tell you, it gives us even more accuracy as to what to expect for the Dow to gold ratio coming up in this cycle. Not only do we cover the Dow to gold, we also cover silver. In Precious Metals Intelligence Plus for our premium members, we also cover the exact gold and silver miners that we are investing in here. You get flash updates going right to your email inbox whenever we make a decision. You're only seeing here about 2% of what our premium members receive. You cannot afford to be without this research if you expect to be an informed precious metals investor over the decade ahead. Precious Metals Intelligence Plus is for you. If you would like to invest alongside myself, Christopher Aaron, if you're a higher net worth investor, we have these private placements that we negotiate with gold and silver mining companies where we receive better terms than even buying these same gold and silver mining companies in the open market. And the reason for that is that we receive free warrants with every investment that we make by private placement. 1 week from now, I will have an announcement as to the next gold mining company that we are investing in. And if you would like to join us at that time, I would love to have you with us. If you would like to sit down with myself, Christopher Aaron, and discuss your situation, how you will apply this information to your personal situation, I would be happy to sit down with you. You can view the available times that I have for consultations on our website. You click on the consultations tab and you will see a link to the calendar after you choose whether or not you'd like a 60-minute or a 30-minute sit down. We talk over the phone, we talk over Skype. If you're in my location, we can meet in person, whatever is best for you. I give you from an independent perspective what I would do if I was in your situation. So remember the importance of this 45-year trend break. I don't know anyone in the mainstream financial world who is talking about this. Not a single person. And that leads me to believe that this is even more significant than I previously thought. If everyone was talking about this, it would probably be some sort of a quirk. But since hardly anyone has even noticed this, I think there's a significant chance that this, in fact, comes to pass. I hope you'll join us.